Let's take a quick check at the Philippine markets. Philippine Stock Exchange opens Tuesday higher by about 1/3% at 6,268. PSCI was down yesterday, Monday, by 1/3%. As for the Philippine peso, it opens Tuesday slightly stronger at 56.33 to the dollar. The peso closed yesterday slightly weaker at 56.42 against the greenback. And the prospect of a surge in U.S. tariffs could threaten some Asia-Pacific banking systems, says Fitch Ratings. Let's dive into the details live from Hong Kong with Jonathan Cornish, head of Asia-Pacific Financial Institutions at Fitch Ratings. So good to see you, John. Welcome to the program.
Thanks, Kathy.
All right, so we're right in the middle of a pause with a minimum 10% tariff rate in place for all, except for China and the U.S., which have been trading barb stare of tariffs north of triple digits. So how is all of this impacting the banking systems in the Asia-Pacific region?
Right, so the imposition of tariffs will likely be negative for the region, potentially more so for the likes of Vietnam and Thailand than is the case for the Philippines, where we view the banking system as exhibiting a degree of resilience and stability in terms of growth prospects. But a pause on implementation certainly leaves some uncertainty there, and that's going to be a deterrent for business investment across the region, and that's going to weigh on economic growth and hit banks' growth prospects, albeit to varying degrees across the region, and it should be largely manageable, especially in the case of the Philippines. That's reflected in Fitch's neutral outlook for the sector, for the Philippine banking system. And that means that we view that the system's prospects for business generation and financial prospects to be broadly similar in 2025 versus last year. We have the same neutral sector outlook on other ASEAN banking systems, except in Vietnam, which is improving, meaning that we expect further improvement this year beyond what occurred last year. But the threat of high tariffs increases the potential that we'll revise the likes of Vietnam's sector outlook back to neutral. Thailand actually could move to deteriorating from neutral, but we see less risk of change for the Philippines overall.
Well, let me pick up on the word you used there, and it's pretty encouraging, resilience. I talked to equity analysts here, and they're all gung-ho over the local bank's profitability and prospects. So from your analysis and putting that layer of, let's say, 17% tariffs, if that goes through, how do Philippine banks compare with various other ASEAN neighbors, considering what they may also see as considering negotiations that are also ongoing as we speak with the U.S.?
Yeah, so the Philippines appears to have one of the lower tariff levels, but what's been flagged by the U.S. administration is still obviously subject to bilateral negotiation. But if the tariff level remains lower, together what is a relatively low single-digit exposure to U.S. exports as a percentage of GDP, then the Philippine economy and banking system should remain relatively stable. Again, the most exposed in the ASEAN region are Vietnam and Thailand. Both have high proposed tariff rates, while Vietnam itself exports to the US accounts for around about a quarter of its GDP. So it's also worth noting that the most recent rating actions on the major Philippine banks were upgrades of their viability ratings, and their viability ratings, or VRs, reflect our assessment of their standalone credit profiles. And the credit rating outlook for Philippine banks also remains stable.
And also supportive when it comes to policy, that really plays a key role. So what do you see is the role that the Bangko Sentral will play in Philippine banks' future growth, as well as the most important metric here, the net interest margins?
Yeah, so the authorities in the Philippines, including BSP, certainly have presided over relatively robust credit growth in recent years, and we expect that to continue. There's genuine demand for credit to support robust economic growth, and growth is likely to be aided by policy rate cuts in 2025 and 2026, which is what Fitch expects to be the case anyway. Ordinarily, though, interest rate cuts tend to be negative for bank net interest margins, the NIMs that you referred to. But in the Philippines, rate cuts have not always weighed on bank NIMs in the past. That's partly to do with the nature of bank lending in the Philippines. So the Philippine banks continue to grow their exposure to high yielding loans, which can mitigate pressures from lower policy rates. And that said, we expect NIMs of the major commercial banks to narrow slightly. And the same goes for our measure of bank profitability, which is operating profit to risk-weighted assets. But this is on the back of double-digit total loans growth, which compares very well among large ASEAN banking systems. So overall, bank earnings should really hold up in the Philippines.
All right, well, that's something good to leave with. Thank you so much for joining us, John Cornish of Fitch Ratings in Hong Kong.